Well, Warren Buffett is 94 years old. In 7 decades of analyzing markets, he's developed a methodology for identifying speculative bubbles before they burst. And right now, if we apply that value investing framework to Nvidia, a stock worth $3.1 trillion that sits in millions of retirement accounts, the warning signals are flashing red. Here's what the principles of fundamental analysis actually tell us about this situation. And I'm going to show you the numbers, because once you see them, you'll understand why this looks so remarkably similar to what happened with Cisco systems in the year 2000. Right now, millions of Americans, school teachers, nurses, electricians, retirees, regular working people, may be exposed to significant risk in a stock with valuation levels that echo the dot-com bubble. And if this follows historical patterns, the potential impact on retirement portfolios could be substantial. We're talking about Nvidia. And before you dismiss this as just another bearish analysis, let me give you one number that should make you pause. Nvidia is worth $3.1 trillion today. That's trillion with a T. That's more than the entire economy of France. That's bigger than Walmart, ExxonMobil, and Coca-Cola combined. And the primary reason it's worth that much is because the market believes AI is going to continue growing at current rates indefinitely, with minimal competition and no cyclical downturns. In value investing, we've learned over 70 years that when an asset price requires perfection to justify its valuation, that's typically when the risk is highest. Now let me be absolutely clear from the start. This is educational analysis, not investment advice. You should verify everything presented here independently and consult with a licensed financial advisor about your own specific situation. What I'm sharing comes from reading actual company SEC filings, analyzing publicly available financial data, and applying the same principles of fundamental analysis that have guided value investors for generations. Let me explain why this situation could actually present greater risks than the internet bubble in 2000. Back in March of 2000, the Nasdaq stock index reached its peak at 5,048 points. All the technology companies in that index had a combined market capitalization of approximately $6.7 trillion. Adjust that for inflation to today's dollars, and you're looking at roughly $12 trillion. That was the high watermark of what many consider the most spectacular speculative bubble in modern American financial history. Now look at today's market structure. The 7 largest technology companies, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, have a combined market capitalization of approximately $15 trillion as of December 2025. Just these 7 companies are worth more than the entire tech sector was at the peak of the dot-com crash. And Nvidia alone accounts for $3.1 trillion of that total. One company, roughly 1/3 the size of the entire 2000 bubble. Here's what makes this situation different and potentially more concerning. In 1999 and 2000, most of the companies driving that bubble had little to no revenue and no clear path to profitability. Companies like Pets.com were delivering products at a loss with no viable business model. Webvan was burning through capital on grocery delivery infrastructure that couldn't achieve unit economics. These were businesses with no fundamental support. When reality arrived, they simply disappeared. Investors lost everything, but at least the outcome was predictable once you examined the fundamentals. Nvidia presents a very different picture. Nvidia is a genuine business with substantial revenue, real profits, and clear technology leadership. According to their most recent 10-K filing with the SEC for fiscal year 2024, Nvidia reported revenue of $60.9 billion, up from $26.9 billion the previous year. That represents 126% year-over-year growth. They generated $29.8 billion in net income, representing a net profit margin of approximately 49%. These are remarkable numbers. This is unquestionably a legitimately successful business. But here's where we need to apply discipline and think like investors rather than momentum traders. At a market capitalization of $3.1 trillion and annual net income of roughly $30 billion, investors are currently paying approximately $103 for every $1 of profit Nvidia generates. Let me repeat that because it's the central issue. Every single dollar of annual profit Nvidia earns is currently valued at $103 in the stock price. Now, what's considered normal in historical context? Over the past century, the average price-to-earnings ratio for companies in the S&P 500 has been approximately 15 to 16 times earnings. Even high-growth technology companies, when they reach maturity and stable growth rates, typically trade at 25 to 30 times earnings. At 103 times earnings, Nvidia would need to deliver nearly flawless execution for many years just to grow into today's valuation. Let's work through the arithmetic using conservative assumptions. Suppose Nvidia manages to grow its profits by 25% annually for the next 5 years. That would be extraordinary achievement given the mathematical law of large numbers. It becomes progressively harder to maintain high growth rates as absolute numbers get larger. At the end of 5 years with 25% annual growth, Nvidia would be generating approximately $91 billion in annual profit. If at that point the market values the company at a more normalized 25 times earnings, still premium but reasonable for a mature technology leader, the company would have a market capitalization of about $2.3 trillion. That's 26% below today's price. So even in a very optimistic scenario where everything goes right, where Nvidia maintains market dominance and delivers spectacular growth, an investor purchasing at today's prices could still experience a 26% loss simply because the entry valuation was too high. And that's the optimistic scenario. What if circumstances don't unfold perfectly? What if competition intensifies? What if corporate AI spending plateaus? What if we experience an economic recession that causes enterprises to cut capital expenditures? Based on historical patterns from similar situations, the stock could potentially decline 60% to 70%. This isn't speculation. It's what we've observed happen repeatedly to richly valued stocks when growth assumptions prove unsustainable. However, past performance doesn't guarantee future results, and Nvidia's specific outcome could certainly differ. Let me share a historical example, because we've seen this pattern before with remarkable similarities. In March of 2000, there was a company called Cisco Systems. Cisco manufactured the routers and switches that formed the physical infrastructure of the Internet. Every new website, every corporate network, every data center required Cisco equipment. The demand was absolutely real. The technology worked reliably. The company was genuinely essential to the functioning of the digital economy. Cisco briefly became the most valuable company in the world, with a market capitalization of approximately $555 billion. Adjusted for inflation to today's dollars, that would be roughly $1 trillion. The investment narrative at the time was identical to what we hear today about Nvidia. Analysts and investors argued, this time is different. The Internet is fundamentally transforming everything. Cisco owns the critical infrastructure. This isn't speculation, it's the future. The stock was trading at extremely high valuations. Investors were paying over $200 for every $1 of annual profit. But sell-side analysts kept publishing research showing that Internet traffic was doubling every 100 days. So Cisco's revenue would continue growing 30% to 40% annually for the foreseeable future. The logic seemed airtight. More Internet traffic requires more networking equipment, which means more Cisco revenue, which justifies higher stock prices. What could possibly disrupt that? Reality disrupted it. By October 2002, just 2.5 years after reaching its peak, Cisco's stock had lost 86% of its value. The price collapsed from $80 per share down to approximately $11. An investor who committed $10,000 at the top was left with roughly $400. And here's perhaps the most instructive part of this history. Cisco didn't declare bankruptcy. The internet didn't disappear or become irrelevant. Cisco continued growing their business and remains a substantial, successful technology company today. But if you purchased Cisco stock at the peak in March 2000, you didn't recover your initial investment until 2024. That's 24 years just to break even in nominal terms. And when you account for inflation eroding purchasing power over those 24 years, the real loss was even more severe. What happened? The core issue wasn't that Cisco was a bad business. It was that the valuation had become completely detached from what the business could realistically deliver. No company, regardless of how good its products or how large its market, can sustain 40% annual growth rates indefinitely. Eventually, competition emerges. Juniper Networks and others began producing comparable networking equipment. Pricing power eroded. Cisco had to reduce prices to maintain market share. Profit growth slowed substantially below what the peak valuation had assumed. The stock price adjusted accordingly, even though the underlying business remained viable. The identical pattern played out with Intel, with Sun Microsystems, with dozens of other technology stocks that were considered can't-lose investments during that era. The technology was transformative and real. The companies survived. But investors who overpaid at the peak experienced devastating losses. Before we continue, let me pause here and remind you. This is educational analysis comparing current market valuations to historical precedents. This is not a recommendation to buy, sell, or short any security. Every investor's situation is unique. You should always consult licensed financial professionals before making any investment decisions based on analysis you encounter online. Now here's what should concern us about the current AI bubble and Nvidia's role in it. Proponents of the current valuation will argue, you don't understand. AI is different. It's a general-purpose technology like electricity or the internet. It's going to transform every industry sector. And you know what? That assessment is probably correct. AI likely will transform industries and create enormous economic value over the next 20 to 30 years. But here's the critical distinction that investors often miss. Transformative technology and profitable stock investments are not the same thing. Let me illustrate with a perfect historical example. In the early 1900s, the automobile was genuinely revolutionary. It fundamentally changed transportation, reshaped urban planning, created entirely new industries from gas stations to highway construction. Over the course of the 20th century, automobiles created trillions of dollars in economic value. Nobody today would question that automobiles transformed American society and the global economy. But here's what investors who lived through that era learned the hard way. In 1920, there were over 100 automobile manufacturers operating in the United States. Over 100 companies, each one claiming to be positioned for the automotive revolution. How many survived as independent companies? Essentially zero. Ford and General Motors survived, but even they required government bailouts and went through bankruptcy restructuring in 2009. Everyone else, Packard, Studebaker, Hudson, Nash, and dozens of other brands, went to zero. Investors in those companies lost everything, despite being invested in one of the most transformative technologies in human history. The same pattern repeated with railroads in the 1800s. Railroads literally built the modern American economy, connecting the continent and enabling unprecedented commerce. But the majority of railroad companies went bankrupt. Investors lost fortunes even though the technology was world-changing. Airlines transformed global travel in the 1900s, making international movement accessible to ordinary people for the first time. But most airline companies either lost money consistently or eventually failed. The internet revolutionized communication and commerce, but the vast majority of Dotcom stocks went to zero. The economic value created by transformative technologies rarely accrues to the companies selling that technology. Instead, Value typically flows to the end users who deploy the technology most effectively to improve their own operations. And even among technology sellers, competition inevitably fragments market share and compresses profit margins over time. This isn't pessimism. This is how market capitalism functions. This is economic history. Right now, Nvidia's revenue is growing explosively, primarily driven by a handful of enormous customers: Microsoft, Amazon, Google, and Meta. These companies are engaged in what appears to be an artificial intelligence arms race. They're collectively spending tens of billions of dollars constructing AI infrastructure and data centers, not primarily because AI is generating immediate return on investment today, but because they're terrified of falling behind their competitors in technological capability. This is what value investors recognize as a land grab dynamic. Everyone is racing to claim territory and establish position, but land grabs have a natural endpoint. Within 2 to 3 years, these hyperscale cloud providers will have completed building out their initial AI infrastructure. At that point, the massive purchase orders will naturally decelerate. And when order flow slows, Nvidia's revenue growth will decelerate, profit growth will slow, and historical valuation patterns suggest the stock price would face significant pressure. There's another substantial challenge on the horizon. Currently, Nvidia enjoys what essentially amounts to a monopoly position in AI accelerator chips. They're the dominant supplier, which allows them to maintain premium pricing. But monopolies in technology markets never persist indefinitely. At this moment, companies in Taiwan, South Korea, and the United States are constructing massive new semiconductor fabrication facilities specifically designed to produce competing AI chips. According to publicly available information about these capital projects, those facilities are scheduled to come online between 2026 and 2028. When they do become operational, Nvidia will face genuine competition for the first time in this market segment. And competition in commodity or semi-commodity markets typically results in pricing pressure. Lower prices generally lead to compressed profit margins. Reduced profitability typically leads to lower stock valuations. This pattern has repeated throughout the semiconductor industry's history. When demand is strong, everyone builds additional manufacturing capacity. When that capacity comes online, supply exceeds demand. Prices decline. Profit margins compress. Stock prices adjust. This cycle has played out for 50 years across every chip category, from memory to processors to graphics to networking. There's no compelling reason to believe AI accelerator chips will be exempt from the same economic forces that govern every other semiconductor market. Let me tell you about who could actually be hurt if this valuation proves unsustainable. This isn't primarily about Wall Street traders or hedge fund managers who can hedge their positions and manage risk dynamically. The people most at risk are regular Americans: teachers, nurses, electricians, retirees, working people who have been told by their financial advisors or read in financial media that you need exposure to technology stocks or you'll miss out on the AI revolution. So they direct their 401k contributions into S&P 500 index funds or NASDAQ 100 index funds without fully understanding the concentration risk. These funds are heavily weighted toward Nvidia without the investor even realizing the extent of their exposure. If this stock were to experience a significant correction, it could substantially impact retirement savings across the country. For people in their 60s and 70s, there may not be sufficient time to recover those losses before they need to draw on those assets. Let me tell you about someone this could affect. Sarah. She's 62 years old, retired nurse from Pennsylvania, worked 38 years in the hospital system. She has $420,000 in her 401k. Not wealthy, but enough for a modest retirement if managed carefully. Her Fidelity advisor told her, "You need technology exposure for growth. You can't just sit in bonds at your age." So Sarah moved 35% of her retirement savings into a NASDAQ 100 index fund. That's $147,000 in tech stocks. She doesn't realize that Nvidia alone represents approximately 8% of that fund's total value. That means $11,760 of Sarah's retirement is directly in Nvidia stock. Plus, she has substantial additional exposure through Microsoft, Amazon, and other companies that are Nvidia's primary customers. If Nvidia were to experience a decline similar to what Cisco experienced, say 70% over 2 to 3 years, and if that decline pulled the NASDAQ index down 30% as a result of Nvidia's massive weighting, Sarah's $420,000 retirement account could decline to approximately $320,000. She would have lost $100,000. That's not an abstract number on a screen for Sarah. That's not market volatility she can wait out. That's 2.5 years of her retirement budget. That's her daughter's wedding she was planning to help fund. That's the new car she needs, because her current one has 180,000 miles. That's 3 years of her life. Gone. Because her advisor told her, you can't miss AI without explaining the valuation risk or concentration risk she was taking on. And here's what makes Sarah's situation particularly difficult. She's 62. If she was 35, she could reasonably expect to work another 30 years and allow her portfolio to recover. But Sarah is living on this money now. When you're 62 and your retirement account drops 24%, you don't have 3 decades to wait for mean reversion. You have to either reduce your standard of living immediately or work longer than you planned. That's the real human cost of valuation bubbles. It's measured not in percentage points, but in years of people's lives. Let me be crystal clear about something important. I cannot tell you when or if this valuation will correct. Nobody can. Market timing is notoriously difficult, and attempting to predict exact tops and bottoms is generally a losing strategy. But what can be assessed with reasonable confidence is whether current valuations are justified by realistic business fundamentals. And based on historical analysis, the mathematics here appear challenging. This valuation cannot be sustained unless Nvidia achieves nearly perfect execution for an extended period, and when highly speculative valuations eventually mean revert to historical norms, as they have consistently done throughout market history, the adjustments can be severe. So what should you actually do with this information? First, understand your actual exposure. If you own an S&P 500 index fund, Nvidia represents a substantial portion of that fund's value. You might have significantly more concentration risk than you realize. Open your 401k statement. Look at your actual holdings. Most people contribute automatically every month without ever examining what they actually own. But if 60% or 70% of your retirement assets are in broad market index funds that are heavily weighted toward a handful of technology stocks, you're taking on concentration risk whether you intended to or not. Second, ask yourself an honest question. Could you financially afford to experience a 40% to 50% decline in your technology stock holdings? Not, would you be happy about it? Nobody would be happy about losses. But could you financially withstand it? If you're 35 with 30 years until retirement, you probably can. If you're 66 and planning to retire next year, you probably cannot. If the answer is that you cannot afford that level of decline, you need to have a conversation with a licensed fiduciary financial advisor about your specific situation. Not your friend who reads investment forums online. A credentialed professional who can look at your complete financial picture and provide personalized guidance. Third, understand the fundamental difference between investing and speculating. Investing, in the value investing tradition, means purchasing assets for less than their intrinsic value and waiting for the market to recognize that value. Speculating means purchasing assets at high valuations and hoping that someone else will pay even more in the future. If you're buying Nvidia at 103 times earnings, hoping it goes to 150 times earnings, that's not investing based on fundamental value. That's speculation on continued multiple expansion. And speculation is a very different activity with very different risk characteristics than investing. If this analysis has helped you understand what's actually happening beneath the headlines and hype, I would genuinely appreciate it if you would click the like button. It takes substantial work to analyze these financial statements, compile this historical data, and present it clearly. And clicking like helps this analysis reach more people who need to see it. More teachers like Sarah, more retirees trying to protect what they've saved over decades of work. And if you want to continue receiving this kind of rigorous, fact-based financial analysis, the kind that examines actual fundamentals rather than just following momentum, please subscribe to this channel. The goal here isn't to sell you courses or push specific stock picks. The goal is to help you understand what's actually happening in markets so you can make truly informed decisions about your financial future. Hit that subscribe button so you don't miss the next analysis. One final reminder before we close. Everything I've shared here is based on publicly available financial data and historical market patterns. This is educational content, not financial advice. Markets can behave irrationally for longer periods than many expect. This analysis represents one perspective based on fundamental valuation principles, not a certainty about future outcomes. Always consult qualified financial advisors for guidance specific to your personal circumstances. Look, value investing principles developed over 70 years have taught us one consistent lesson. Price is what you pay, value is what you get. Right now with Nvidia, there appears to be a substantial gap between those two things. The stock price is very high. The question is whether the underlying value justifies that price. Could the stock go higher in the near term? Certainly. Speculative bubbles can persist longer than rational analysis would suggest. Momentum can drive prices higher even when fundamentals don't support those prices. But history has shown us repeatedly that when valuations become detached from fundamental business reality, the eventual adjustments tend to be severe and rapid. Don't allow fear of missing out to drive you into making decisions with your retirement savings that aren't appropriate for your specific situation and risk tolerance. Stay disciplined, stay focused on fundamentals, and remember that no stock, regardless of how transformative its underlying technology, is worth any price. Here's your timeline to consider. Nvidia reports quarterly earnings on February 26, 2025. That's approximately 73 days from now. Microsoft reports on January 28th. Amazon reports on February 1st. If any of these companies indicate during their earnings calls that they're moderating their AI infrastructure spending, or if they guide expectations lower for future quarters, you could see significant volatility in Nvidia's stock price. Some analysts suggest the stock could gap down 20% to 25% on disappointing guidance before regular trading even opens. You have roughly 8 to 10 weeks to examine your portfolio, understand your exposure, and determine whether you're comfortable with the level of risk you're currently taking. Because once those earnings reports are released, and if they disappoint market expectations, the opportunity to adjust your position at current prices will have passed. This isn't about creating panic. This is about making informed decisions with adequate time to think through the implications. You've worked too hard and saved too carefully to lose substantial portions of your retirement because you didn't understand the risks you were taking. Thank you for watching this analysis. Please share this with anyone you know who has significant money in the stock market, particularly anyone approaching retirement in the next 5 to 10 years. They need to understand not just the upside narrative, but also the fundamental risks and historical patterns. The information is publicly available. The historical precedents are clear. The warning signals are present. The only question is what you choose to do with that information. Don't be someone who says 6 months or a year from now, "I wish someone had explained this to me." Someone is explaining it to you right now. Make your decisions accordingly, with full awareness of both the opportunities and the risks.